Hi, welcome to the Advanced Auditing and Assurance Module 1 classes for CPA. We will be discussing about Module 1, Assurance Services Framework. For the convenience purposes, this entire module has been divided into three parts, Part 1, Part 2 and Part 3. For Part 1, we will be covering the following topics and then after we go on to Part 2. In auditing, in this module, the first thing that we need to understand is that the topic name is Advanced Auditing and Assurance. However, the way we use the terms auditing and assurance could be different in the auditing scenario, in the world of auditing. Auditing and assurance both are having very closely related standards applicable to them, but then the major point of difference between them is that auditing is always focused more on the audit of historical financial information. For example, balance sheet. It is already prepared and then somebody comes and audits it. That is a major difference between auditing and assurance. So we will have a look at what is an auditing, what is assurance, and try to run through the module. And assurance, as I said, is usually the practitioner comes and gives an opinion on something which is not a historical kind of an information. That is one major difference. So now we look at all these topics covered under this module and try to go forward from there. So first thing we try to understand is what are the basic terms, what is IFAC, IAASB and AUASB. So the IFAC is the International Federation of Accountants. It is headquartered in New York and it has member bodies from all across the world. For example, latest in 2014 statistics, it has around 200 members from over 100 countries. CPA Australia, for example, is a member of this body. Then we discuss about what is IAASB. So the International Auditing and Assurance Standards Board is what it stands for, IAASB. So this is a body which set all the standards and try to serve the public interest. They clearly set high quality international standards which are applicable in case anybody is doing an auditing, even a quality control or review or any other kind of assurance a practitioner is trying to give, or any other kind of related services, for example, tax consultancy or maybe just consultancy and other things, bookkeeping. So the board IAASB, they're independent and they are the ones which come up with the relevant standards. For example, in accounting we have IFRS. Similarly, IAASB issues standards for auditing and assurance, and in case you're trying to do any other kind of related activities or quality control, any other kind of other things you're trying to do, so then they try to give up what is the applicability of the standards depending on the kind of assignment you are doing. And since IAASB is an international body, every country may have their own local boards as well. For example, in Australia, we have the Auditing and the Assurance Standard Board, which was established in Australia under the Australian Securities and Investment Commission Act 2001. So they try to give the standards for Australia as such. So this is the reason IAASB is now in the process of a convergence, in the sense that they are trying to harmonize especially the US, European and other international standards so that everybody has almost the same procedures for auditing and other assurance services. The reason being, everybody follows their own standards and the Australian and the IAASB is trying to bring everybody on a similar platform. So the Australian framework, although we conform to the international framework for assurance engagements, our standards are not very different from the international ones. However, we do have some minor differences. And usually, practically speaking, Australia has a little more stringent requirements in comparison to the international standards. So anywhere if you're reading, if at all the word AUST is written, it means that this is a requirement specifically applicable in Australia, which may or may not be there in the international standards. Or if it is there in the international standards, maybe it has some different requirement or a different condition. So this is the reason Australian framework, we have a conformation with our international framework, but then ultimately we do have some minor differences which are represented by the word called AUST as a prefix, which means it is only applicable in Australia. So now we try to understand what are the different pronouncements which the International Auditing and Assurance Standard Board, which is the IAASB, has come up and how they are applicable. Okay, so for the purposes of this pronouncement, all the codes are described as under the quality control standards, ISQCs. ISQCs will stand for International Standards for Quality Controls. So it is not possible practically for any kind of a practitioner to comply with the standards if he is not complying with the code. We have to comply with the code here. Okay, so ISQC 1 to 99 are all the standards on international control. We have the International Framework for Assurance Engagements. So as I said, assurance is a broader term which includes auditing of non-financial information as well. But this is the reason the International Framework for Assurance Engagements has been divided into two. First of all, they talk about standards for audits and reviews of historical financial information. So if we are trying to do any kind of an audit, we have to follow the international standards on auditing, ISAs 100 to 999. And if you're trying to do a review engagement, then we have to follow ISRES 2000 to 2699. If at all, looking at the other side of it, if at all we are doing assurance engagements which are not exactly audit or review or historical financial information, then we have ISAEs, International Standards on Assurance Engagement 3000 to 3699, and it also has a wing for any other kind of related services, which are your International Standards on Related Services, ISREs 4000 to 4699. And broadly speaking, the different kind of standards issued by the IAASB are all covered to do different kind of engagements. For example, audits, review engagements. This is a code from the IAASB. So ISAs, like for example in accounting you have your International Standard on Accounting. Here we have International Accounting Standard, IAS. Here we have ISA, International Standards on Auditing, and these are to be applied to the audit of historical financial information. If at all you are doing a review, then you need to apply ISREs. If at all you are trying to do assurance engagements, which are you're dealing with other kind of information which is not exactly historical financial information. For example, the practitioners which can be appointed to comment upon the prospectus which the company may be issuing for issue of shares or a sustainability report. That means any other kind of an information that you are trying to give an opinion on, but it is not exactly a historical financial information, which is non-financial, and in most cases it is future oriented. And lastly, if you are trying to give any kind of a consultancy, tax, bookkeeping, compilation, then we follow international standards on related services. In Australia, we have our own pronouncements, which are almost equivalent to the international ones. So the International Standard on Quality Control becomes ASQC, Australian Standard on Quality Control in Australia. International Standards on Auditing become Australian Standards on Auditing. So likewise, we have pronouncements which are equivalent to the international ones. As I already mentioned, any requirement which is a little more strict has already been mentioned as with the term with the prefix of AUST. Okay. So now we understand that what is the kind of Australian framework, and we have already seen that ISAs are applied to the audit of financial information, ISREs are applied in the review of historical financial statement. Any other assurance engagement in which we are not trying to do any historical stuff, then we try to put ISAEs. Any kind of non-assurance services, because when we try to give a consultancy, when we try to give a bookkeeping, then we are not kind of providing any assurance to the client. It is just a related service. Then we have to apply ISREs. So the IAASB in Australia, they issue guidance statements as well. So each of the guidance statements will include in detail what is the standard type, what is the purpose of the guidance statement. It is for helping the practitioners in completing their work properly. They will clearly define what is the objective of the guidance statement, what are the kind of definitions and meaning they are looking for, where all the guidance statement can be required, the requirements, and also they will try to give where all it can be applied, and any other kind of appropriate procedures or other explanations which they may seem necessary for the purpose of complying with the guidance statement. So now this is what the guidance statement we were talking about. So we issue in Australia, they issue guidance statements. We clearly have all other kind of application and other explanatory material as I already discussed. And also ASAs, I mentioned that we do have a little more strict requirement than the international level at times. But this is the reason we can have some standards which do not exist at the international level at all. For example, ASA 101, Preamble to Australian Auditing Standards. This kind of a standard which is basically the preamble is something which is in the beginning of a book. Similarly, preamble in Australian accounting standards ASA 101, it basically means that how the legislation intends to apply and understand the Australian standards, how to interpret, how to apply them, how to understand. This is why the preamble is there. So we look at what is the preamble to Australian auditing standards, and as I said, it is only unique to Australia. It is not there internationally. So it outlines how the IAASB, which is the Australian board, how they intend, that is the legislation, how they want to understand, interpret, and apply the standards. So let me make one thing very clear here, that only the auditing standards are having a force of law. Other standards are not legally enforceable. When I say legally enforceable, it undoubtedly means that there is no way that you can do a non-compliance with the standards. If at all the entity you're auditing, or if at all you're providing a review, or we'll see what the standard covers. But if at all any of the aspects of auditing standards is applicable on the kind of business you are auditing, then you have to comply with the auditing standards as they are legally enforceable. So what all the term auditing standards for the point of view of legally enforceability, and generally also what do we mean by what do we mean by when we say what is auditing standards? So they include all the ASAs, Australian Standards on Auditing. They also include the Review Engagement Standard 2410 for a review of a financial report performed by the independent auditor of the entity. And they also include Australian Standards on Quality Control for firms which perform audits and reviews of financial reports, any other kind of financial information, and other assurance engagements. There could be other standards which are not exactly focused on the historical audit and review of the financial information. They could include general reviews, like let's say I hire you to understand what is the position of internal control effectiveness in my business, or maybe I'm just trying to understand the performance of my business, or I'm trying to evaluate the efficiency of my business. Then they do not are included in the term called auditing standards. And as I said, only auditing standards have a legal enforceability in Australia. So this preamble is something which is unique to Australia. Let's also try to understand the other Australian specific requirements which are not there internationally. So our international standards on review engagements, the ISRES, they contain two standards, ISRE 2400 and 2410. So when I say ISRE 2400, this is a standard to be applicable on the review of financial statements, where somebody else, some other practitioner who is not the auditor of the entity, he comes and reviews and undertakes an engagement to review the financial statement. For example, if Mr. A is the auditor of company X, then Mr. A is not doing the review here. Somebody else is coming down, another practitioner is coming down, and he has undertaken the engagement to review the financial statements. So ISRE 2400 is applicable then. And if at all it is ISRE 2410. This is for the review of interim financial information. Now, we only release, for example, for a non-listed company, we try to release the financial information public once a year. But for other companies like public listed entities, there could be multiple reporting periods. For example, you could be asked to report per quarter as per the laws applicable to you. So there could be a review of the interim financial information. So this could be done by the independent auditor of the entity. So here we are talking about two situations. One is where the auditor of the entity does the review, then 2410 is applicable. If at all some other practitioner is coming down to do the review, then 2400 is applicable. However, in Australia, there have been few changes in the Corporations Act for companies, specifically the companies which are limited by guarantee. And this is the reason for such kind of companies, they have issued a specific Australian requirement called ASRE 2415. These are to be followed by all the companies which are limited by guarantee. This standard is not applicable for other kind of companies, only for companies which are limited by guarantee. And there has been a change in the Corporation Act. Internationally, this kind of a requirement for companies limited by guarantee is only applicable in Australia. ASRE 2415 does not really have an international equivalent. So all such companies which are limited by guarantee for the purposes of ASRE 2415 have been divided into the following three tiers. The first tier belongs for company which have an annual turnover less than 250,000. So if they are less than 250,000, they are actually exempted from doing the uh, financial reporting and auditing as well. The three tiers once again. So any company limited by guarantee which has a turnover limit less than 250,000 is exempted from the financial reporting and auditing requirements. And this table is specifically applicable for companies which have a limitation in terms of a guarantee, limited by guarantee. And then we come down to the second tier of companies which have an annual revenue between 250,000 and a million. And they must prepare a financial report, but they have a choice that they can choose between whether they want to get it reviewed or they want to get it audited. If they want only review, they can probably go just for a review. However, under the third tier, which is a company with more than a million of revenue, then irrespective of whether the company is deductible gift recipient for tax purposes or not, it has to get an audit done. And also for financial reporting purposes, a proper reporting is required along with a streamlined director's report. So this is a requirement only in Australia for companies limited by guarantee. And in the tier 2, in case a company has a revenue below 250,000 but is a tax deductible gift recipient, even they can decide to choose between a review or an audit. So this is the turnover limits and the three tiers for companies specifically in Australia. So this requirement is not applicable in any other country. So if you are confused in the sense that which standard to apply as per ASRE 2415 for limited companies, then if at all the auditor has only conducted the audit of the previous report of a company, then the auditor will have considerable knowledge about the company. Then probably ASRE 2410 is more appropriate, just to make sure that the auditor only is doing the review only for the simple reason that he has already conducted the review. So he must be having a detailed in-depth knowledge of the company. If that is not the case, the auditor has not conducted the review of the previous company, maybe because it is a new company. They do not really have a prior kind of requirement of an audit, then the auditor will not have obtained an understanding of the entity and its environment, then probably we can get somebody else to review the entity's financial statements. So this was about the companies which are limited by guarantee. Now we move down to our next topic, which is International Framework for Assurance Engagements. So International Framework for Assurance Engagements is like a guidance, is like a framework which is issued by the IAASB, and it applies to all assurance engagement. It helps in understanding in what engagements what to apply, as in if you have to apply ISAs or you have to apply ISREs, ISAEs or ISRS. The framework itself is not a standard. It does not have its own requirements of performance. However, it just talks about that what is the kind of rule book or a kind of a framework. Rule book, not exactly something which is legally enforceable, but just like basic guidance and the kind of framework and the overall fence within which the practitioners need to work. So it has the main topics of discussions like ethical principles and the quality control requirements, the definition of assurance engagements, what all does it cover, what is it meant to be a reasonable and a limited assurance engagement, any kind of attestation and direct engagements, and it also talks about the elements of an assurance engagement. So in an assurance engagement, we usually have a three-party relationship. One party would be somebody who has prepared the financial statements. The other one would be the user, and the third one will be who is the provider of the assurance. So financial statements is only for auditing purposes, or if any other thing is getting an insurance report done, then the preparer, the user and the assurance provider, the matter on which the subject matter on which the assurance is being provided, what is the criteria against it, what is the kind of evidence the practitioner has collected for issuing the report, and a proper assurance report as well. So this, for the purposes of this module, these elements are the ones which are going to be discussed in great detail. So this is like a mapping, and all the further contents of this module will rotate around these main issues only. So we will talk about ethical principles in detail, we will talk about quality control in detail, and we will talk about each of these elements also in detail, so that we can understand from an overall point of view what does the framework say, the international framework for assurance engagements. So we will see how it applies and what are the kind of different requirements and the main issues for this kind of an engagement. So first thing we will talk about is the Code of Ethics for Professional Accountants. This will come under the requirement of the ethical principles for the International Framework for Assurance Engagement. So let's talk about the Codes of Ethics for Professional Accountants. If any of you would have already done some kind of an ethics exam in the past, that you would understand that accountants need to follow the Accounting Professional and Ethics Standard Board's APES 110 Code of Ethics. This is something all the accountants need to follow. So IFAC has established what we call as IESBA, which is your International Ethics Standard Board for Accountants. They are the ones who develop ethical standards. They try to understand for every kind of standards, there's a board which has a specified responsibility. So like for auditing, we have been saying that the there's a board for putting down the auditing standards. We know that there's a board for putting down the accounting standards. Similarly, we have ethical standards board called as the IESBA, which is the International Ethics Standard Board for Accountants. So they develop the ethical standards for accountants, and the code here, the APES 110 Code of Ethics, is the central standard. And in Australia, the Accounting Professional and Ethics Standard Board, which is the Australian equivalent of the International Ethics Standard Board for Accountants, they have issued the APES 110 Code of Ethics for Professional Accountants, specifically applicable in Australia. And it all the Australian requirements, since this is adopted from an international code, anything which is specifically more required in Australia, then the letters, the prefix AUST will be there in the code. These letters will symbolize that this kind of a requirement is only applicable in Australia. The code is divided into three parts. Part A is about the introduction and the fundamental principles in the code which are applicable. And part B applies to professional accountants who are doing public practice. That means, for example, the audit practitioners. Part C applies to professional accountants in business. Now, since we are trying to understand the basics of auditing and assurance, so part B is of extreme importance to us of the code. Part B applies to all the professional accountants in public practice. This is the reason we will be trying to understand what is the requirement of part B. It is a very, very extensive requirement. It gives a very, very practical guidance on various circumstances, various kind of situations, various kind of relationships an assurance provider may be faced with, and at times he may have some kind of a threat in complying with the basic fundamental ethical principles. So this is the reason part B is the main focus of this code in terms of your module requirements. Part C is comparatively smaller, somewhere around only 11 pages. It only is about professional accountants who are in business. So obviously the people who are in a public practice will have far more requirements in comparison to professional accountants who are in business. The reason being, even legally and practically, the people who are in public practice, they have far more independence requirements as per law also, and as per the demand of the profession also, in comparison to professional accountants who are in business. So part C is kind of limited. It has only a few circumstances and relationships which can probably come up for people who are doing professional accountants who are in business and how to deal with them. Okay. And ASA 102, the Australian Standard on Auditing 102 is your compliance with ethical requirements when performing audits, reviews, and other assurance engagements. It clearly specifies that the auditor, the assurance practitioner, engagement quality control reviewer all have to, and even the firm as such, the firm of practitioners, even they have to apply with the code as such. So ASA 102 is quite designed to particularly suit the Australian ambience of law, and there is not an equivalent standard on this internationally. However, it does take references to the international ethical requirements in case there is no specified requirement for Australian people. However, APES, whenever it gets amended, automatically ASA 102 is also amended by the AAASB, so that they do not really have to amend any other kind of AAASBs. So in crux, if I put it, that we do have requirements which are internationally recognized as well, but we may have our own laws. Probably the most relevant law is the Corporations Act here. So in case we have our own law, and as soon as there's any change, APES 110, if we amend it, then we also have to amend AS 102. Because of these two things, the other thing do not really have to be amended. So we now look at the fundamental principles that we have been talking about, that what are the kind of fundamental principles which the code has established and as part of the professional conduct. The first thing is about integrity. Integrity, to be very simply defined, it is a principle which requires that a professional accountant has to be straightforward, he has to be honest, he has to be trustworthy, honorable, reliable, and even courageous. Now, all these attributes are quite important for an accounting profession, and they have become all the more important because of the recent frauds which have come up, like Enron and Arthur and Anderson and the Lehman Brothers. All these things have come up, and these collapses have actually generated a kind of a disbelief in the public sector that actually accountants are required or not. So this is the reason, even as a basic characteristic, an accountant has to be integrate, and more so ever due to recent developments, integrity has become a very, very key fundamental principle of the code to be complied with all the chartered accountants and CPAs, professional accountants in short. So once you're a professional accountant, It is an obligation that you be straightforward, put up your things honestly. You have to be a person who can be trusted, honorable, reliable, and courageous. The next is objectivity. Professional accountants, of course, they are human beings as well. So they may be exposed to certain situations wherein they could have got into some kind of relationships professionally. For example, if I audit my husband's company, then probably I may not be able to maintain an impartial attitude in my work. This is the reason objectivity is quite important. It is a duty on the professional accountants to avoid those kind of relationships or those kind of situations which probably can reduce their objectivities while they are trying to take a professional judgment. They have a basic duty to avoid such kind of things. Nothing should be there which creates a compromise or some kind of an undue influence of others which makes them compromise their professional and business judgments. So we should, for example, law cannot cover all the scenarios that what we can audit and what we can't audit. Nobody can say that, okay, you don't audit your best friend's company. But then it is my own duty to see that, okay, if it is my best friend's company, probably I may not be able to maintain an impartial attitude towards my work. So this is a reason objectivity is important. And as a professional accountant, objectivity is definitely a fundamental principle which cannot be compromised upon. So we should avoid all kind of situations which can land up in a situation wherein we are not able to take an unbiased professional or business judgment. Then we come down to your next fundamental principle, which is professional competence and due care. Professional competence and due care has numerous aspects to it. One thing is that, of course, professional knowledge and skill is required. If at all there's a client and we are trying to take up an engagement, let's say to do an audit or let's say to provide any other kind of an assurance service, we should be a competent professional, and this will only happen when we are aware of the current developments in practice, the current changes in legislation, the current changes in how the audit is done, the techniques keep on getting updated. So of course we are required to have a qualification as a professional, but then it is also about maintaining and updating our knowledge, and that can come through continuous professional judgment. Continuous professional development. So it's not that once a degree is there, it's done and forgotten. That's not the case. It should be a continuous professional development that the professional accountants should try to maintain so that they are updated with the latest affairs. And that is the reason they are expected to have a professional competence and due care, which probably people in anybody else is not expected to have that kind of a professional competence. This is the why we are called as professional accountants. So we should have a professional competence both in terms of an existing qualification plus with continuous professional development. We should be updating our knowledge and experience every day. We should try to keep up with the current developments. And another responsibility is that of the due care. Due care in the sense that we cannot be very negligent and careless about our approach towards work. We have to act diligently in terms of whether it is as simple as applying a technical standard, and why, because it's a kind of a professional service that we are trying to give. So we have to make sure that the kind of responsibility which is bestowed on us, it is a responsibility to act very, very carefully. We have to be in depth involved with what we are doing. We have to be thorough with what we are saying and doing and acting. And that too we are required to perform on a timely basis. So professional accountants, if you feel that you are not in a position to do it on time, do it properly, or probably you do not have that required kind of a skill, then you are requested to decline a job on your own. For example, even if I'm a professional accountant, auditing and accounting are very, very big fields. So it's not necessary that I'll be an expert for everything. For example, let's say a particular merger is happening and the client has come to me for related services, compilation. Now, if it is not my expertise area, I do not have the required skill, and probably I should decline the job. It shouldn't be that people come to us and we are not able to provide a good service. The next fundamental principle is that of confidentiality. Okay, so the professional accountant, earlier we read in the integrity concept that we are expected to be trustworthy. So similarly, we are not expected to leak any kind of a confidential information about the client or about the professional business relationships to a third person. Only we are supposed to do it only when there's a legal and a professional duty, or there's a specific authority by the client that okay, you are okay to discuss. I'll give you examples for this. For example, bank has come to you because the client has applied for a huge loan with the bank. So the bank has come to you asking for details about the client. Are they solvent, or how is their liquidity position? You cannot disclose information unless and until you have a specific authority agreed with the client, and usually it is always better to have such authority in writing. If the client is permitting you that please disclose our details to the bank, then you can do that, otherwise you cannot. On the other hand, let's say some kind of a forgery or some kind of a fraud has happened at the client's place, and you as an auditor are requested to come to the court and give a statement. Then it's a legal duty. You cannot say no. So I can sum it up like this, that you are expected to maintain confidentiality of information about the client as a professional unless and until there's a specific authority by the client or there's a legal or a professional right or duty to disclose, we will not be disclosing any kind of an information about the client. The last fundamental principle here is your professional behavior. So we should be making sure that we are the ones complying with all the relevant laws, regulation. We are not expected to do anything which brings discredit to the profession, because we have a duty towards the client but also towards the profession and in general towards the public. The professional accountant has its first and primary duty towards the public. So we have to act in a manner which promotes the good reputation of the profession, and we should not be doing anything which brings discredit to the profession. So these are your 5 fundamental principles. I'll just take you back to make sure you're in line with what we are doing. We are trying to understand the matters discussed within the International Framework for Assurance Engagement, and we are trying to understand the ethical principles for the same. So this is the Code of Ethics for Professional Accountants, which comes under your ethical requirements and ethical principles. So we are understanding what is the code all about, what are the fundamental principles the code has mentioned. So now, since we have looked at the 5 fundamental principles: integrity, objectivity, professional competence and due care, confidentiality and professional behavior, now we should also try to look at the threats and going forward the safeguards. Threats in the sense that what could be some kind of threats which can come up which may stop us from complying with the fundamental principles. So this is the reason where we need to evaluate the threats. We will also come down to a decision box about what to do with the threats. If at all the threats are really significant, then we have to apply some kind of a safeguard to either completely get rid of the threat or eliminate them, or at least reduce them to such a level that at least my fundamental principles are no longer compromised. If we are not in a position to do that, the best thing to do as a professional accountant is to either decline the proposed engagement, or if you're already doing a professional service, probably to discontinue the specific professional service, or you could resign from the client, or if you're working as an employee, you can resign from the employer's place. So let us look at the different kind of threats. 5 threats are here which can stop us from complying with the fundamental principles. The first threat is a self-interest threat. It may occur in case we have a financial or any other kind of interests as a professional accountant in the client. For example, if I have a major shareholding in the client's place, or let's say my wife or my husband of a particular person is the CFO of the client which you are auditing, and they are getting their salaries based on the profit numbers, the variable pay, then automatically you have a self-interest. The better the client's professional, the more the salary for your wife, or the more my shares value. Then I have a self-interest threat associated with the client. In this case, definitely I'll not be able to be objective with my work in the client's premises. So this is the reason we have to do something about it. We can take some safeguards, or if we are not in a position to take, then probably to discontinue. Then we come down to self-review. For example, I provided the bookkeeping services for the client. Tomorrow the same client comes to me and asks for an auditing done. Now I was the one who did the bookkeeping. I may not be now expected to do the audit, because it will be something like I wrote the exam and I'm checking it myself. So my own judgments will have to be reevaluated again by me or any other person in my own firm. So that would be a self-review threat. This is something considered to be as a very severe threat. That is something that we are not expected to do. Next thing is an advocacy threat. So advocacy threat in the sense that, for example, in many legislations and jurisdictions, the chartered accountants are they're allowed to go and present the tax cases of the client with the tax offices, for example, ATO. Even if you're not a lawyer, a professional accountant can go and present the client's case in the tax offices. So now if I'm the auditor also for a particular client, and I'm trying to, on the other hand, advocate him in front of the tax office for his tax cases, then it is something as an advocacy. I'm trying to promote a position or an opinion for the client to such a level that my objectivity is compromised. This is something which is not allowed, and it is considered as a serious threat. Next thing is familiarity. Now what happens, even professional accountants are human beings. Too much of a long or a close relationship with the client, usually we try to become friends with the clients. That is the point in time where we become too sympathetic of their situations, or we just take their work as it is. Probably we do not really drill into it from a professionally questioning mind as we should be as a professional accountant. So this is also one kind of a threat we should really look into. Too much of a long relationship with the client, for example 10 years, same auditor, same client, same people. This is also a threat that an auditor needs to look into, where to draw a line between the professional and the personal interests. Last thing is intimidation. Let's say, because there could be actual threats, or maybe there could be perceived threats where you are trying to be stopped or deterred from acting objectively. Maybe the client is pressurizing you to increase their profit numbers. So this is something called as an intimidation. So now all these safeguards which have been discussed, with all these threats which have been discussed here, we have to create a safeguard for them. We can create a safeguard in the work environment of the assurance client itself. We can create safeguards in our own audit firm. Probably when the client, if they are sensitive about the different threats, they can create safeguards in their own work environment. Or we can also create a safeguard in terms of the profession by doing something legally, or by legislation or regulation that we call. So safeguards which are created by the legislation and regulation come from the bodies like, for example, in Australia, ASIC, Australia's Securities and Investment Commission. They enable their legislation and the Australian Securities and Investment Commission Act, the Commonwealth. So there we can look at what is the law saying as a safeguard for us. Or there could be other safeguards which the assurance client has tried to put in their own work environment. For example, whenever the client's management proposes that this person should be appointed as an auditor, other people than the management, not the management themselves, other people could probably be looking at that who is appointed, and they could probably ratify or approve the appointment. The client should have competent employees to take the most important managerial decisions. All kinds of policies and procedures which the client has shows that they are quite committed towards a fair financial reporting. There doesn't seem to be like a possibility of a unfair or fraudulent financial reporting. The internal procedures which the client have are very, very kind of strong in commissioning non-audit work. The client doesn't promote any kind of it doesn't promote any kind of the non-compliance with the law. It has a strong corporate governance. It has a strong effective audit committee. So all these things present that the client is themselves very serious about having a fair financial reporting. Within the audit firms, the practitioners can probably set their own rules to comply with the ethical standards which are above law. For example, they can be very clear about how to maintain the relationship with the client. They can have a very, very strict acceptance procedure for new clients, whether to do or not to do. They could be having their own rules on how many shares permitted for each client, about the other partners. So the audit firms can have their own rules to make sure that these threats don't come up for them. So in exercising whether you have a significant threat and what kind of a safeguard you should put, you should accountants should definitely consider what a reasonable and third party would kind of like to conclude in this case. You should think from a third party point of view. So in summary, we can put the safeguards like this. So first we should check and establish fundamental principles. Then we should see if there are any kind of potential threats which may stop us from complying with the fundamental principles. Then we should try to apply safeguards. And then again, after applying the safeguards, again we should be reviewing. If the threat is reduced to an acceptable level, then it's all right. We can continue the engagement. If the threat still exists, we should not accept the engagement and try to deny the engagement. This was about your safeguards. Then we talk about part B of the code, which we have been discussing, the most important element of the code. Part B is applicable to professional accountants in public practice. We will be looking at multiple sections which are relevant to the public practitioners here. First thing is, let's talk about the professional appointment clause. Whenever we are trying to accept a new client, a professional accountant who is in public practice, he should understand that if at all I am accepting this client, is there anything which comes up as a threat which stops me to comply with the fundamental principles? For example, if threat may be like, let's say for example, a new client has come up and he has a specific requirement for which neither me or my team is equipped. So we will not have the required competencies to do justice to the engagement. So in these circumstances, either we can acquire the knowledge of the relevant industry, update ourselves, or if we are not in a position to do that, probably we should just deny the engagement. In Australia, there are significant additional requirements which are a little more strict. So they say that if the auditor has been an officer or an employee who was very, very critical to the audit of the client, then in the past 12 months, then accepting an appointment is not permitted. For example, a CFO of the client comes and resigns and joins my audit firm. So now for the purposes of continuance of that audit of that client, now we cannot accept an appointment because the CFO is an audit critical employee of the client and he has come as join us. So now we cannot do continuance of the audit, or we cannot accept that client as a prospective client. So Australian requirements apply in this case. Another requirement could be that in case an accountant is there who has been asked to replace an already existing auditor, he must request the client's permission to go and communicate with the previous or the existing auditor to find out and communicate about the client. If at all the client is not allowing you the permission, you have to decline the appointment. And on receiving the permission from the client, you should go to the previous auditor and you should try to request all the information so that the relevant kind of an information which will help you to take a decision whether the appointment has to be accepted or not. This is the first requirement in code part B. We discussed about the professional environment. The second is your conflicts of interest. So conflicts of interest, probably it is somewhere wherein your interest versus the client's interest comes into picture. For example, let's say a professional accountant in public practice is trying to perform services for two clients whose interests are in conflict, both are competitors. So then it is a responsibility on the professional accountant to notify all the related parties that they are acting on behalf of more than one party and try to obtain their consent. There could be other situations wherein you could have conflicts of interest. For example, in the same audit firm, two big competitors are getting audited. So you can apply safeguards like using separate engagement teams, and the teams are given clear instructions that they are not going to breach any kind of confidentiality requirements or security issues. They will not be discussing any kind of details about the client. You should have a strict physical separation of such teams. You can get the confidentiality agreements signed by the employees and the partners of the firm. And a senior person who is not directly involved with the client engagement, he should continuously keep on reviewing and seeing whether the safeguards have been actually applied or not. So this was your second requirement, conflicts of interest. The third is about a second opinion. There could be an intimidation threat which comes to you when the client has gone and taken a second opinion about the issues in the financial statements from another accountant, and probably you are not giving a very favorable opinion about the same, and some other accountant has given a favorable opinion in the favor of the client. So then the client starts pressurizing you that the other accountant is saying this, so you also please try to change it. They try to create pressure on the existing accountant. So you may not be objective in this case, but then you have to seek permission from the client to contact the other accountant who has given this kind of a view, and you should obtain a copy of the second opinion, and still you should try to see whether on what basis the other person has issued a second opinion. You should not get intimidated and directly given to the pressure created by the client. You should still do what, as per your professional judgment, the stand which you think is right. Then we come down to the next requirement about fees and other types of remuneration. So when the fees from a client, it is a large part of your firm's total fees, then definitely it will create some kind of objectivity issues. The reason being, we will not try to do anything to displease the client, because we know if the client goes, then we will also lose a major chunk of our fees. So this could create some kind of objectivity issues, and we fear that the client may leave us and choose some other practitioner. This is the reason we try to just give in to the client's requirements, which is not correct. In Australia, they have a strict requirement that if at all from one particular client, assurance client, if at all you are receiving more than 15% of the firm's total fees from one single client, then an additional independent professional accountant has to come down, review the work, and documentation has to be delivered to the professional body, engagement partners professional body, for example, the CPA Australia or the CA Australia. And also in Australia, there's another requirement that if at all the fees represent a substantial part of the gross income of the firm, then probably you should just refuse or withdraw from the engagement. For example, one single client is owing to 75% of my work, then probably I should consider refusing the client or withdrawing from the engagement, because my objectivity may be impaired in this case. Another thing is gifts and hospitalities. So the client may try to give you or your immediate close family members something on account of friendship or loyalty, or probably try to give you expensive gifts. Now this dealing with this kind of offers of gifts is a very difficult issue. It will all depend on what is the kind of value, the nature of the gift, and what is it that the client is expecting in return, the intent behind the offer of inducements or gifts. So if at all we feel that by accepting the gift or the offer of hospitality, for example, client is saying that they would take you on a 5-day all-paid trip to Gold Coast, then if at all you feel that this is a kind of an threat which is going to come forward. Taking advantage of this gift, they would probably be able to intimidate you later. It would create an intimidation threat, and we should flatly refuse going forward because it will definitely damage your reputation, and the client may at times also threaten you to make this as a public thing that he paid for a holiday for you and your family. This is although a very very difficult issue. There could not be any clear cut thing, but let's say for example on Christmas everybody is getting a bonus voucher of, let's say, whatever is the standard for other employees. If everybody is getting $100 voucher, probably the client has given you the same as well. There's no intention behind that they're expecting you to intimidate you or create any kind of a threat. Then probably it should be okay to accept that gift. So offers of inducements, we can sum it up that always see the kind of value, the nature and the intention behind such gifts in hospitality. Often if it hints towards any kind of a threat, it is a good idea to just reject the offer of gift or hospitality. And the last part is also about independence. The independence is one of the main pillars of the auditing and the assurance profession. So accountant has to be independent, not only in terms of requirements by law, also in mind and in appearance. For example, the law cannot stop me from auditing my best friend's company. But if I do that, even if I'm doing my work honestly and diligently, in appearance, it would be looking like that I am not independent. This is the reason accountants should act with integrity, exercise objectivity, be always having a critical thinking. It is called as professional skepticism. And we should try to avoid any kind of circumstances which would make any person believe that our integrity, objectivity is getting compromised. So the independence is not only important in mind, but also it should appear that you are independent. So in Australia, under the Corporations Act, the ASIC, Australian Securities and Investment Commission, they have the responsibility for surveillance and investigation and make sure that the auditor is independent. So the code requires that the accountant should identify what kind of threats they might have towards their independence, try to apply safeguards, and if they are not in a position to do the safeguards, just decline or terminate the engagement. So the sections 290.102 to 290.231, they kind of describe examples of what kind of threats to the independence can be there. What are the kind of safeguards which can be adopted to reduce these threats? So we finish our first part of your module 1. We will carry forward in the next session with part 2 of your module 1 classes. Thank you very much.